So, hi guys, welcome back. Today we're going to be looking at PayPal holdings. Over the past few months, the stock has plummeted. It's down from close to $308.50 back in July and is now trading at $188 now. It's close to a $120 drop and a 40% decline in its stock price, bring to where I see a much more accurate valuation of the company for a company that was quite overvalued a few months ago. I've been looking at this company on and off for the past year or so. I believed it was too overvalued earlier this year, and you can see it crashed in the beginning of this year as well. Went back up to 308. It's now crashing all the way to $188 right now. PayPal is a fintech company. It operates in online money transfers, and one of its most popular subsidiaries is Venmo, which is quite popular, especially in the US, Canada, and Australia as well. And in 2020, it had a revenue of close to $21.5 billion, and the stock kind of started crashing after its Q3 earnings. So today we're going to be looking at why PayPal stock crashed. We're going to be looking at whether this is a good entry point for the stock, the stock's possible catalysts in the future. We'll be looking at a bit of that bank statements. Is there something fundamentally wrong with the company? And then finish it off with some technical analysis. So if you do enjoy, consider subscribing. It is free and it does help me out a ton. If not, thanks for watching anyway. On to the video. So the first thing we're going to be looking at is a Motley Fool article talking about why PayPal stock slumped today. This was written on November 17, 2021. So if we look about a week ago, this is when the stock was trading at closer to $215, which is solid 12% decrease since when this article was written. So shares of e-payment specialist PayPal Holdings fell 5.2% at 2:10 p.m. EST trading on Wednesday afternoon, and you can blame Bernstein for that. So in a note out this morning, investment banker Bernstein cut its rating on PayPal stock from outperforming the market to market perform, which means it'll perform in line with the market and it's not really a standout investment. And it cut its price target on the stock by more than 15% to $220 per share. Note currently the stock is trading at $188. So even if you agree with this, Bernstein cutting its target price, you're still buying the stock close to $32 less than where they believe it is a fair valuation. So as StreetInsider.com reported, Bernstein is worried that PayPal's business is at risk of being disrupted from two separate directions. On one hand, bankers sees big e-com companies like Amazon and Shopify getting even bigger and gaining more clout in terms of being able to negotiate favorable trades with services like PayPal. And on the other hand, analysts see that PayPal is suffering a potential death from 1,000 cuts as rival payment companies nibble away at its business. Buy now, pay later, Apple Pay, and Shop Pay are all threats to PayPal's dominance, warns Bernstein. So too is the situation in which shoppers place their credit card information on file with an e-commerce company, such as paying with a card becoming shoppers' default way to shop, so they don't even consider whether they might or might not pay with PayPal. So now what? Valued in excess at $250 billion, costing 50 times earnings and more than 50 times free cash flow, PayPal is priced like a fast-growing growth stock, but it actually grew its sales only 13% last quarter and grew its earnings less than half that fast. Make no mistake, despite all the criticism, PayPal remains an incredibly profitable and free cash flow positive business. But when it comes to PayPal's stock, Bernstein is right to worry that there is a disconnect between the stock's valuation and how slowly it's been growing lately. So basically, wrap up, they're looking at increased competition, Amazon and Shopify having more negotiating power, and a lot of competition leading to slower growth for PayPal. And more or less, I agree with this, but there are some benefits that we're going to be looking at what PayPal can do in the future to offset these harms, and why $188 for a stock that was trading at $310 only a few months ago is kind of an oversell, and it might be a good time to enter the market. So next is an article on Seeking Alpha. So if we just scroll to the top here, once it loads. Here we go. So PayPal went through a significant drop in pricing this year, in part because the growing competition from fintechs and e-commerce companies is fueling concerns that PayPal's moat in digital payment solutions is coming under attack. PayPal also received a big downgrade last week, which accelerated the sell-off. So putting a bearish chart picture aside, however, shares of PayPal may represent a stronger value even now that they are on sale. This is because PayPal will continue to grow transaction volumes processed through its platform and recent partnerships with large e-commerce companies that have the potential to fortify PayPal's leading position in the digital payment market. PayPal is teaming up with Amazon to offer the Venmo payment options for shoppers at checkout. The payment solution will be available in 2022 to US customers on the Amazon webpage and also available on the Amazon shopping app. Amazon is not the only company PayPal is partnering up to increase its reach of its payment platform. With a market penetration rate of 75%, PayPal Checkout remains the most popular online payment solution for merchants, but PayPal continues to add new merchants to its payment network. These partnerships, especially with large online retailers like Amazon and Walmart, are set to improve PayPal's market position relative to other fintechs. So, this is from the investor relations page. So they say that they're ubiquitous with the industry-leading presentment. PayPal Checkout is now available across 75% of the top 1,500 North American and European retailers, and we continue to expand and deepen relationships across our merchant network. They have partnerships with Walmart, Booking.com, Fanatics, GoFundMe, Everlane, Valero, and Philips as well. Much are set to go public in Q3 or Q4. So Venmo, which is owned by PayPal, provides mobile payment solutions to the people in the US who can send and receive money through Venmo's digital wallet. Venmo's popularity is surging and the company is processing an increasing amount of transactions through its relatively new payment platform. Venmo is the second largest digital wallet in the US after Zelle, and based off annual transaction volumes, as you can see here, it has overtaken Square in 2019. Partnerships with large online retailers like Amazon and Walmart could push Venmo to becoming the #1 digital wallet in the US. Growing TPV, revenues, and cash flows. So PayPal presented a strong earnings card for the third quarter, and shares of PayPal should not have cratered. Growing e-commerce volumes imply a high use of digital payment services, and PayPal is set to profit from this relation for years to come. PayPal added 13.3 new active accounts in the third quarter, and the business ended the quarter with 416 million active accounts, showing an increase of 15% year over year. These accounts conducted $4.9 billion in payment transactions in Q3 of 21, up 22% year over year, and the total payment volume processed through PayPal surged 24% year over year to $310 billion, while revenue soared 13% to $6.2 billion. PayPal is also very profitable regarding free cash flow, and the payment service provider saw its free cash flow increase 20% year over year to $1.3 billion, which calculates to a free cash flow margin of 21%. All of this has basically been condensed into a graph if you want to pause and look at it in a more in-depth way. Revenue growth. The outlook for PayPal is very positive. PayPal forecasts net revenues of $6.85 billion to $6.95 billion for Q4 of 2021, implying a revenue growth of 12 to 14% year over year. For financial year of 2021, PayPal expects net revenues of $25.3 to $25.4 billion, implying 18% growth over the year earlier period. Also based on spot rates, PayPal's total payment volume is expected to grow between 33 and 34% this year, showing consistent growth with one of PayPal's most important platform metrics. Because of the drop in pricing, PayPal's revenue and TPV growth are discounted heavily. PayPal is expected to grow revenues 20% next year to $30.3 billion, and PayPal is also projected to generate $36 in earnings per share in the financial year of 2022, which calculates to a PE ratio of 36. Shares of Square, PayPal's closest rival, are significantly more expensive on a PE basis, and the rapidly growing size of PayPal's merchant growth may be the biggest reason to buy PayPal at a discounted revenue growth. So if you look at PayPal and why it has basically dropped, one of their biggest competitors would be Square right now, which has a market cap of just under half. It has the 2022 revenues at about 2/3. Its price to sales is a lot cheaper. However, their earnings per share is a lot lower, and their PE ratio is almost 3.5 times higher than PayPal's. So although their price to sales ratio is slightly lower, their PE ratio kind of offsets that when you tie in a lower market cap, a lower revenue, and a much lower earnings per share. You can see why PayPal still has the edge over Square as of right now. However, PayPal still does come with some risks. Fintech companies are growing rapidly and their products are getting better and better. The rise of the digital payment economy implies long-term growth opportunities, but also challenges for PayPal and other e-commerce companies. E-commerce companies can be expected to develop their own online payment and processing business to cut out the middlemen or partner with buy now pay later companies that make the checkout process as frictionless as PayPal does. A decline in PayPal's revenue growth rates and a lower free cash flow margin pose risks to PayPal's valuation long term. But right now, a stock price of $188 with a growing earnings per share, a decreasing PE ratio, and a price to sales ratio that is not exorbitantly high is still kind of worth when we're looking at short to medium term growth for PayPal. And then you can always reevaluate after the stock has recovered, maybe 2 to 3 years down the line. Next is 2 more reasons why the value trend, another Seeking Alpha article, and why they believe why they will continue to hold on to PayPal. So their analysis continues to support that PayPal is on track to deliver the growth and returns that I expected weeks ago. In this regard, PayPal offers growth at a reasonable price. It is profitable and well-established company that is going nowhere. More specifically though, 2 factors that make them especially bullish on PayPal is Venmo and the power of its balance sheet, which we will be looking at later. Starting with Venmo, this is perhaps the biggest reason why they think PayPal still holds plenty of value and growth potential. Venmo is one of the most popular payment apps in the United States, and in 2020, over $159 billion in transactions were processed through Venmo, and the app is on track to deliver $900 million in revenue in 2021, according to the latest earnings call. But Venmo is barely scratching the surface of what it can achieve, both in terms of growth and monetization. So when it comes to the latter, more specifically in monetization, we can see that Venmo can still come a long way in terms of monetization if we compare it to Square Inc.'s Cash App. Again, one of PayPal's probably more competitive businesses, or one of PayPal's larger competitors. According to estimates, Cash App produced $54 per user in 2020, while Venmo only makes $12 from each active user. There are slight differences in transaction costs, but more of this comes from the fact that Cash App is used more for cryptocurrency transactions. This is something that Venmo can easily replicate and take away the economic moat that Square Inc. has with its Cash App right now. In terms of growth though, Venmo can go much farther. Originally, Venmo was conceived as a peer-to-peer payment system, but this is quickly moving to business too. Amazon will be accepting Venmo payments starting in 2022, and I believe that this will see significant success. Venmo has a place in the mobile phones of 65 million people, and this is something that PayPal can leverage to its advantage moving forward. Another big reason that they will continue to hold PayPal is its incredible balance sheet and all the growth opportunities that this opens. PayPal has $13.29 billion in cash and negative net debt. This is a much stronger balance sheet than its most established peers, such as MasterCard, and it is now time for PayPal to put this money to good use and expand its platform. Especially internationally, which is something we got the taste of in the last investor presentation. So this is once again from the investor presentation. They had a deal announced on September 7th, which was acquired for $2.7 billion, principally in cash. They made a headquarter in Tokyo, Japan, with more than 200 employees. In 2021, they had a gross merchandise value run rate of close to $1.5 billion US. They expect Pypl to contribute 3 million NNAs in 2021, and multiple buy now pay later products, including single pay, 3-pay, multi-pay, and pay in 90. And this is them expanding into Japan and increasing their reach there. So why are they reading into Japan? So Japan is the world's 3rd largest e-commerce market. It has a $5 trillion economy, its GDP, with a population of close to 125 million people. Online shopping volume has more than tripled over the last 10 years to about $200 billion, and more than 70% of Japanese consumers have shopped online. Digital commerce and cashless transactions are growing, but close to 70% of all purchases are still paid in cash, and this is one of the few developed markets where cash on delivery is still used for digital commerce. And because more than 70% of all purchases are still paid for in cash, this is a big market that PayPal can break. Rapid growing of Pypl solutions illustrates that consumers are seeking more seamless, secure, and flexible ways to pay. Especially with PayPal's $13.3 billion in cash, that is something that they can invest in, and if it is something that pays off, it'll be a massive market that they can breach, and one of the first major corporations to have a significant foot forward in Japan, one of the largest e-commerce markets in the world. So on September 7th, it announced that PayPal was acquiring Paydi, which uses AI to find out the creditworthiness of its users and offers payment installment plans. This is just one example of how PayPal can enter new markets and expand its footprint. Much like they argued before with Shopify, PayPal can now leverage Paydi to also push its other payment platforms into the Japanese market, and I'm very excited to see what other acquisitions that PayPal can make. Next thing we'll be looking at is with PayPal Holdings. First thing, we're just going to be looking at their balance sheet. You can see that their earnings per share has consistently increased. Even in 2021 to the trailing 12 months, it has been pretty solid. Don't really pay any dividends. Book value per share has been increasing, nowhere near their actual stock price, but it is a good sign that it is increasing over time. The operating cash flow, cap spending, and free cash flow are all on an uptrend, which is a very, very good sign for the company after a dip in 2018. Which means basically the company has more money coming in, the company is spending more money and reinvesting into its company more and more, and it also has more free cash flow at the end that they can invest later into acquisitions such as Paydi, as we saw earlier. Looking at some profitability rates, we can see that their net margin is close to 20%, which is pretty solid, and is hovering between about 15 to 20% over the past few years. Could be better, but it's not too bad, and especially for a company that is trying to expand into the international market, especially in towards Asia. A 20% net margin is pretty healthy. Return on equity currently is 24%, with a 22 and 15% earlier. So once again, not amazing, but a very, very solid return on equity for a company that is trying to expand. Its interest coverage of 23 years is very solid, and they are extremely conservative with their debt to equity of just 0.36. So overall, its balance sheet is very, very solid. Next thing we'll be looking at is just their financial statements. We can see their revenue has been increasing. They went from about 15 billion to 24 billion in the trailing 12 months. Their operating income went from 2 billion to 4.28 billion. Then their income went from 2 billion to close to 5 billion. Their EBITDA in billion went from 3 billion to about 6.7 billion. Their diluted earnings per share went from $1 to 71 cents in 2018 to $4.16 in the trailing 12 months, and then normalized diluted earnings per share went from $1.93 to $3.23. And overall, it has had a very, and you can just basically see in the graph here that the revenue is increasing and the net income is increasing. Overall, a very, very good sign for the company. The last thing, as I said at the beginning of this video, is we'll be looking at some technical analysis for PayPal. It is very, very clear that the stock has settled into a downtrend. It is trading not yet. It is trading close to its 200-day simple moving average. Its 20-day simple moving average has converged with its 50-day simple moving average, and the stock does look like it is trending downwards. However, if we look at this price, it's the same price that basically the stock was trading in September of 2020 after a correction. Many people bought. It went all the way to about $310. It dropped again, went up, and I see the stock. I see the stock rebounding soon, but the lowest I really see the stock go is close to its 200-day simple moving average. We saw this base back in 2020, and the stock basically rebounded there. So I don't believe the stock will go below 168. I believe the 200-day simple moving average is the lowest the stock will go, but I will not be surprised if the stock starts rebounding soon, maybe going down to about $180 before rebounding, because stock has consistently been going down basically since July, and it's been July, August, September, October, November. It's been about 4.5 months that the stock has been continuously trending downwards. For a company this size worth about $500 billion, a company that has deals with Amazon, a company that owns Venmo, a company that has a very, very big say in the financial technology space, which is one of the largest growing sectors on a global level. I don't see this company that has this massive market share really bottoming out and consistently going down for about 5 months. So I believe PayPal is a very good company. I believe it has the potential to regain its mojo. Even if it doesn't, I do believe $188, $190 is a good time to enter the market. If you remember, the Bernstein had a target price of about $220, and this is much, much lower. $32 on $220 is a significant discount for what it is. Plus, it's under $200, which is another plus because the stock is trading at a very, very cheap price. Things to note, though, they do have a quite high price to sales, about 7.5, and their PE ratio is still about 45. So the stock is overvalued in terms of the objective metrics, But if we're taking in factor future growth, if we're factoring in the power that this company has on a market level, I do believe 188 is a very good time to enter the market, and the stock has good potential in the future as well. So this brings me to the end of the video. If you do enjoy, if you found this video useful, do subscribe, do comment, do like the video, and send it to someone who might be interested in PayPal as well. If you made it all the way to the end, thank you for watching, and I'll see you in the next video. Bye.